Jeffrey, thanks for joining us today.
Oh, it's my pleasure, Steve.
Tell me about your plans in the U.S.
Well, in the U.S., we'll take one step back. As you know, we started the company with an Asia-focused, put together a platform that is the largest owner, largest developer of logistics facilities in China, largest owner of logistics facilities in Japan, largest overall in Asia. But with the customer concentration we have in Asia, those customers, both non-Asian companies, companies like DHL, companies like Unilever, companies like Adidas, that have requirements elsewhere in the world, it makes sense to help serve their requirements in other major markets, obviously the US being a very, very large market. So we see the opportunities there. We think it's part of a long-term global footprint and intend to execute on that as it makes sense.
And what about in China? That's an area that's got a growing real estate market, particularly commercial real estate. Some would say even looking bubble-like. What's your opinion on that?
The bubble that people talk about is really focused on residential, more particularly high-end residential in very limited markets. It's Shanghai, it's potentially Beijing. Clearly Hong Kong worries me from a bubble standpoint, and there's been some articles about that recently. And that's where people really talk about a bubble in valuations. Within the industrial sector, we see no signs of a bubble. In fact, our leasing velocity is the strongest it's ever been. We're 150% above our previous records prior to this year over the last few months. So it's very, very strong. We're seeing good customer demand. We're seeing a limited amount of competition, rising occupancy rates. It's a real strong market. There really is strong GDP growth. And more importantly, within our sector, with the warehouse sector, domestic distribution is really what drives demand. 86% of our product is focused on domestic distribution, and that's what the Chinese government is really trying to foster and grow.
That's very interesting. Now, so in China, would that suggest that commercial real estate prices are rising versus the case in the US where things are contracting? Could you compare the two?
I'd say over the last 18 months, they've been relatively stable to up slightly. Very market contrast, but then again, you have a market contrast between a country where you have 8.5% GDP growth and a country where you've had significant negative GDP growth for almost 2 years, and finally potentially coming out of the deepest recession since the Great Depression. So it makes sense. You also have the difference where there was much more speculation from a commercial development standpoint, save for a couple of the major cities where you do have, like Beijing, some overbuilding in the office sector and high-end hotel sector or lodging sector. You've had, a difference in the credit markets with the amount of securitization, the CMBS that was done, the 85, 90%, the mezz loans, the level of sophistication that created problems because people were buying buildings, financing buildings on the expectation that rents would continue to rise and eventually they'd be able to make their debt service. Obviously, that's a game fraught with risk that's not turning out very well.
And today that creates opportunities. Is that one reason why your timing for looking at the U.S. is so current?
There's a business drive. There's an overall business reason to be in the U.S. and be in Western Europe to serve customers on a global basis. Think about our customer set. It's very, very different, far different than residential. If you're a multifamily developer or owner, the chances of leasing an apartment to someone in Paris and Shanghai are very, very small. The chances of leasing to DHL in both those markets are extremely high if you serve them well, or a Unilever, or a P&G, or you can go on and on, the Nippon Expresses of the world. So we do have global customers, which is even different than retail. Retail, you have Zara and H&M that are have a global footprint. Our customers are really all truly global players, major manufacturers, major logistics companies. So it does make sense. Then from a timing standpoint, if you have an opportunity to buy in when things are distressed, when you buy at good pricing, clearly far, far better pricing than you would have seen 2-3 years ago, the opportunity could be tremendous.
Well, let's talk about that pricing. I think it was in September you were quoted as saying that you thought prices had further to fall in commercial real estate. Still feel that way, or?
Still feel that way. If you look at the wall of debt, the 1.4 trillion, 1.3 trillion of CMBS coming due in the next 3.5 years, if you look at, the amount of loans on the bank, mid-sized banks books, anything below the top 10 banks or so that has been extended and with the, and the expectation that someday it'll be a performing loan again. It's making debt service,
extend and pretend.
Extend and pretend, exactly. I was trying to not to say that, but that's exactly right. There's more pain to come in that regard. There's been more support on pricing because there's been so few transactions, and you've got this wall of private equity capital that was raised that has subscription agreements that are expiring that people want to get out. So when a good asset comes on the market with decent term on it, so you have some cash flow going out 4 years, 5 years, 6 years, 7 years, there's more bidders. There's more buyers than there are sellers right now, so it's artificially kept pricing at a certain level. But I think there is further to fall with the debt situation the way it is, and just the overall loss of jobs. I mean, you've lost 7 million jobs. Nobody talks about that coming back. Even the most optimistic politicians don't talk about bringing those jobs back very fast. So you've got an inherently weak job situation. I don't know how that could bode well. The fundamentals aren't good, that's for sure.
Let me just put it under the microscope a little bit more. Moody's CRP index is down somewhere around 40%. I haven't seen the latest, but that within the last 6 weeks or so, since 2008, I guess.
Right.
Or maybe that's over 2 years. But in any case, where do you think that index would be 6 months from now?
Yeah, I think most of the fall has happened. Can it go down a little bit? Maybe I'm overly optimistic. I've tried, I don't, by nature, not draconian, and the sky's falling and the world's coming to an end. It's hard to survive long-term being that way. But it's, I think you've seen most of the value fall, but there may be a little bit left. Mm-hmm. So it's not a bad time now, and for the right opportunities, it could make sense, but you could see some continued weakness.
So when it comes to opportunities, is there a way to slice and dice that by geographic or region or by industry? How do you
when you say industry,
slice that around? Well, I guess geographically, you're in the logistics business, so I would say I would guess that New York and Newark and LA would be very interesting to you.
Exactly.
But industry-wise, I don't know if you're all over the map or where you think the opportunities might be.
I think there's going to be opportunities to buy geographically on a very diverse basis within the U.S. and within Europe, for that matter. But in my mind, if you believe that values are attractive, when everything's on sale, you might as well buy the best. Kind of like walking into department store and they're having a 70-80% off sale. It's not that values are down 70-80%.
Right.
Don't take it that way, but you might as well look at the better markets. Look at the LA, the Southern Californias, the Northern Californias, the Seattles, really the coastal markets. I kind of went through the strategy with somebody, and after I drew on a map, they said, "You just drew a circle around the outside of the U.S." I looked at it and said, "Yeah, I guess my 7-year-old daughter could have done that," because you kind of went around and went New York,
New Jersey. It's the port business.
Yeah, New York, New Jersey, went down to Washington, D.C., Baltimore corridor, came down to Atlanta, because Atlanta really is a proxy for the Port of Savannah, which I think is the winner with the Panama Canal being widened. You bring it into Savannah, but why keep anything in Savannah? Nobody, you don't have any population density. You got great rail connections and trucking connections, but I almost said, taking you up to Atlanta, so you might as well take your containers off in Savannah, drop them on rail cars, take them up to Atlanta, distribute out of there, then getting down to Florida, coming across to potentially Houston market again, a port market, and coming back in around LA. So you've drawn a circle around the U.S. And again, it's the port markets, port and population densities.
The bargains that you're talking about, would you describe them as a perhaps once in a generation opportunity? Would you go that strong?
There were some great bargains in the early 90s. Whether the bargains will reach that level again or not, I'm not certain. It will take further price destruction or value destruction to get to those kind of levels or those kind of values again. But let's hope that we don't see anything this bad again in our careers. And let's hope that we have very long lives and very long careers, but it doesn't get this bad again.
How's the refinancing situation changing?
That is a great question, because it's shocked me in the last 3 weeks how much better the debt markets have gotten. Whereas, it was difficult to do anything above 50% leverage 3 months ago. Now you're starting to see lenders with very competitive pricing at 65% leverage. And you're seeing spreads come in dramatically. I mean, right now you could do on stabilized assets 65% financing at 6 to 7% fixed for 10 years, which in my career is historically low rates. I mean,
what do you attribute that to?
Well, one, you have very, very low base rates. I mean, the treasuries are extremely low, so the spreads are still high on a historical basis, but they're much lower than they were 3 or 4 months ago. I think actually what the Treasury did with TALF has helped. I know they got criticized. I know it took them a long time to get anything done, but they've seemingly broken somewhat of a logjam by supporting some TALF issuances, and it seemingly has helped out in the real estate credit markets. Now, I've had friends that complain that there's still no debt available at 85% leverage levels, and that's what they're used to getting. But I'm not sure that that's the way real estate really should be played. I mean, there's inherent risk in that. There was a lot of 85, 90, 95% leverage deals in the past, and that's, I don't know that the government should support that, or I don't know that, really we want the public sector to find ways to replace that debt. If there's readily available debt at 50, 60% leverage levels, what we need to find is equity to bridge the gap. Two problems at play here. One, you have 85% leveraged assets that have fallen 35% in value, so you're negative 20 on your equity to begin with. Now you have this new value, the 65 cents on the dollar, and people are only willing to lend you 60 cents on that, so you get 40 cents of debt versus your 100 before, so you're at 40% on the original. There's an equity gap. One thing that we spent some time on is FIRPTA, talking to people in Washington. We've seen a lot of receptivity on FIRPTA relief. And FIRPTA is the Foreign Investment and Real Property Tax Act, which was passed in the 1980s when there were a few senators that were scared the Japanese were going to buy all the farmland in the U.S. Didn't happen, wasn't going to happen, but it was a little xenophobia. And now it's onerous for foreigners to buy real estate. They're treated differently if they own REIT stock than they are if they own GE stock. It's tax wars. Why should that be? If they want to buy, my friend Steve Ross, Vornado stock, why should that be taxed any different than buying GE stock? It shouldn't be. If they want to own real estate in a fund that's put together by Blackstone or put together by me or by anyone else, why should that be taxed differently? We need that equity in the U.S. desperately in the real estate markets to help out the markets, to bridge that gap, to make real estate less leveraged and to bridge the pain. And I think we're getting, they're getting it in Washington, and hopefully we'll get some relief there.
Just to go back to one thing you mentioned at the beginning of your last answer, you talked about leverage now at 65%. People are complaining, some friends are complaining that it's not 85%. Isn't it those upper levels that help to contribute to the problem to begin with?
Oh, it is.
Too liquid, too much leveraging?
I don't think that we should have 85% debt out there. I don't think the government should do anything to support the return of 85% leverage. If we've helped the credit markets reestablish themselves at the 50, 60% level, now we need to help bring more equity into the market.
One last question. You talked about what's happened to interest rates, at least in the last 3 weeks. We'll see if it lasts. But I find it interesting that happened despite Dubai World. Not that Dubai World is a neutron bomb, but certainly you would think that would have something
you
more
would
of an effect
think
on the market.
It hasn't, within debt rates or real estate debt capital markets in the U.S., it has little effect. Obviously, it's had a massive effect on Greece, on the sovereign bonds there. I think people's perception of risk has changed a little bit, but Dubai bought some great assets, but there was a lot of leverage involved in it. But they do have some great assets, and some smart people there. So hopefully they'll work their way out of it.
Thanks very much for joining us.
Thank you. I appreciate it. Thank you.